Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision, offering your solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. Go. Thank you, and welcome all. This is the Special Situations cast, and today my very special guest is Lily Francus. She's a PhD in bioinformatics. She's developed a cool trading strategy, and she did a lot of interesting blog posts around Gamestop. Welcome, Lily.
Thank you. Glad to be here.
No, yeah, great to have you. Maybe I'm curious. Can you tell us how you became interested in markets? Because, maybe bioinformatics is a little bit different, right?
Just a little bit. I have my background actually originally is in software engineering. I went to USC for undergraduate, so I actually did computer science and business. And, from that, I always was kind of interested in the markets. I knew it was a way to grow wealth, and I knew it was important for growing wealth. When I started my first job, which was a software engineer at LinkedIn in 2016 after I graduated, I immediately was in the market because, I got stocks, and thankfully I got Microsoft when it just kept going up. So I've been in the market. Oh, sorry?
Oh, that's what they do, stocks.
I know. I got it right. If you look at basically when I started at LinkedIn and when Microsoft and all the tech stocks went parabolic, exact same time. So, nice. I always joke with people, I'm not diversified because there just never was a good point to sell. So I, was always interested in the markets in that way. I was more of a long-term investor, not really actively, trading or anything. That kind of changed earlier in 2020, when the market crashed. A lot of people were like, whoa, this is a great opportunity to get into, trading, get into the market in general. So, I started, like everybody else did, with basically downloading Robinhood and, started option trading because, I'd been a long-term lurker on like Wall Street bets. And, I didn't know much about the Greeks. I didn't know much about options or even the market in general. Past, stocks go up over time. And I just, kind of fell in love with it. I got pretty active in like the trading community because way back in May, like everything just went up. So you could buy calls on literally anything and make a lot of money. And basically that led me to this service that one of my friends, in this community had mentioned called Unusual Whales. If you're not familiar with Unusual Whales, they're an option flow sweeper. So they detect like unusual option volume. And more interestingly, they had a Discord, which if again, not familiar with Discord, it's really like a chat app like Slack or like what AOL Instant Messenger used to be. And
yeah, and so, okay, can I ask a question about that? Because it's actually not something that I looked into a lot, but I think there's a lot of traders that put a huge amount of stock into these option sweeps at certain strikes for events. And there's also a lot of academic research in those areas. So is that why that you were attracted to that? Or why do you like that?
First off, I consider the creator of it, basically he's a good guy. Like we chat pretty often. But when I was originally, brought there, I actually wasn't even a subscriber for the service. My friend told me this was a cool place to like talk about options. So I joined and I, kind of got a feel for it. There's a lot of conflicting evidence for does it work, does it not work? Anecdotally and also due to like Unusual Whales' own analytics on this, basically it's been working this year. Whether it will continue to work over time is more of a question. There is research basically because I used to do a lot of like analysis on earnings and like post-earning moves. that option flows before earnings are predictive of like the earnings announcement, because a lot of informed traders, especially, will historically at least go into the option market because of the increased leverage. So it's a lot easier not only to, expose yourself more to the underlying move when it hops up, let's say 3%, 5%, 10%, but it's also a good way to not impact the underlying and still get all access to like a lot of leverage.
Sure, yeah. I think with any like event-driven strategy, that's also why I kind of like them. Options are really ideal because you can get much more like surgical exposure to what you want.
Exactly. Like you're not going to get more leverage for cheaper than options. And
Yeah,
in general, I mean, it's just a great way to magnify for a binary catalyst the outcome. So either you lose all your money or you make a lot of money.
yeah, yeah. We also remove like a lot of risk because I don't know. No, of course I can't remember his name, but it's a great trader, and he basically said that you can get your exposure to like what your thesis is, and you can remove all the noise. If I go long with the stock for like this event, then sometimes I have all this exposure that's not going to matter, or that I need just to harvest that event. Well, with an option you don't need all that. Yeah, and sometimes you can hedge it out with a short, like if you go long a stock and short, but it's, yeah, I think it's a really
Yeah,
interesting instrument.
I mean, I think a lot of people feel the same way because, like you said, with options, you have a pretty capped downside. So instead of holding a stock and saying, okay, I could literally lose all my money here, you buy a call option if you are bullish on it. And when you buy a call option, you're only really risking a fraction of what it would be if, let's say, the stock went to zero.
Yeah, yeah. I can also like give the pushback from like I come from like the traditional value, like the Warren Buffett upbringing, and then the idea against options has always been like that. You like if you do the fundamental analysis, like it should go up because you did the analysis, but you don't know when. Like that's because from that lens or that perspective, that the market is super unpredictable on a short term basis. And that's really interesting because you actually developed or co-developed a model and you call it Nope, right? Can you
Yeah,
explain that? Or
I can definitely explain it. So I mean, it's still in progress. It's more. It started as a side hobby, but it kind of, once I started posting predictions, it kind of ran away from me. I've been really glad to see that a lot of people, throughout the finance community have taken a look at my data. Since the beginning, I've always, believed that it should be like this open project because I don't come from a finance background. I do come from a data analysis background. So, I could see these correlations, for instance, but the actual causative factors or, even making sure that this passes like sanity check through stuff like slippage and transaction costs, those are stuff that I've, been really fortunate to meet other people who can, I can bounce ideas off of. But this model, nope, we came up with a funny name because, I definitely regret the name, but it stands for the net options pricing effect. And effectively what, we tried to do here, I think in the beginning it was mostly me. Now, like I said, we have a team of people who either, passively or actively contribute to research on it. It effectively models the traded delta flow of options, especially on the S&P intraday. So if you're not familiar with what delta is, I can go into it briefly if you think that'd be helpful.
sure, yeah, I think so.
Okay, so options are really defined by this concept called the Greeks, where these are relationships between the underlying relationships with volatility itself, relationships with time, relationships with price, and how it impacts the option contract that you bought or sold. So what's interesting, I think a lot of people do not understand about options this way, is the effective price of an option. If you ignore stuff like the seller's premium and, degenerate market cases, the price of an option should be more or less identical to buying and selling the underlying share at a certain rate. And what that means is if I have a 50 delta position, which is the Greek delta on the option, what that means is at this price, at this time, my total market risk of holding this contract can be neutralized by buying 50 shares. If, let's say, I sold you a call option. And if I sold you a put option that had, let's say, 50 delta, what that means is if I short 50 shares, I'm flat. So whether the market moves up, whether the market moves down, I don't care. I have no risk. And what's interesting about delta is, like I said, this hedging ratio. Over time, the only way that, especially on single stock, equities, the only way to really stay flat is to keep buying and selling the shares. And what happens is you have these institutions and other traders sometimes who their job really is to just make money buying and selling these option contracts to you. And they really make money more on what's called the bid-ask spread. So they quote a price for bid, which is that's how much they're going to pay you for it if you sell it to them, and they quote it for the ask, which is how much they're going to charge you if you want to buy it. And these individuals do not like directional risk. They would rather stay flat because remember, they're going to make money on the bid-ask spread no matter if it goes up, if it goes down, if it goes sideways. And the way they stay flat is, like I said, by hedging out their delta. So when they have an option contract, what's interesting is they need to continuously hedge their deltas because delta isn't like a line or a flat number. It changes based on where the price moves and how long the option has to live. So those people are called market makers. And a lot of news has been about them this week, a lot of news that's been partly correct, partly incorrect. And what's interesting is that historically, the options market wasn't a big part of the market. If you look past, let's say 2017, 2015, options were growing, but they weren't, on equities, they weren't a large portion of what was traded intraday compared to shares. And my speculation here is partly due to the Robinhood effect, people now getting access to zero commission options. Around 2013, 2015, 2017, you start seeing that options are playing a larger role in the market intraday and how the price is being defined on their underlying. And what's interesting is until like 2007, there wasn't really any research, academically at least, saying that options actually had any effect on the underlying at all. In fact, one of the earliest papers on this was this guy, Priceman, who I think he works at Citadel now, who basically said, yeah, there is a correlation here between options being traded and hedging and returns. And this was kind of a big, deal because
it's kind of a short-term relationship, right?
It's a short term, but it's a fairly robust relationship. So the impact of, let's say, the delta traded today or this week or whatever would only really last for a couple of days. But the amount that's traded and the amount that goes on here is pretty stable over time. So it has this longer relationship on it.
Okay.
So, but it's interesting because, we've seen over the last years, and I have it from data on the S&P, for instance, that not only is this option dominant effect, as I call it, growing, but it's actually growing at a faster rate. And what that means is that this hedging of options that's done dynamically by market makers is also playing a larger impact on actually defining the price movements intraday. And, my hypothesis is it's playing a large role on defining price movements between days.
Right. Yeah, there could be a lot of reasons for that. Like, I think maybe I think the Mike Green argument with about the passive move to passive, and if then the remaining active traders, if that's going down, and if some of them switching to option trading more and more, um, maybe it's natural for options to get a greater and greater impact as the active share dies.
So that's an interesting way to look at it, and it's completely correct. I mean, there is, I'm sure, some portion of the market that was previously traded in share volume is now traded in option volume. But what's most concerning for someone who studies this like me is the implied leverage of options. And this, when we talk about GameStop, I can go into greater detail of what this means, but effectively options represent shares, but they don't represent people. And what happens is that there's a very formulaic way that these shares that represent the options have to be treated. Because, like I said, the other counterparty of the trade, they need to hedge their market risk. And that means that they have to trade, they have to sell stock and buy stock at fairly regular rates, which has the tendency that as the underlying moves up or down, it magnifies the move. Because if the price of the stock goes up and there's a ton of call options on it, then market makers need to basically buy more stock, which tends to increase the price more, which means market makers need to buy more stock. And the problem is, and this is, why my model has such an interesting relationship to crashes or corrections or whatever you want to call periods of market going down for a couple of days or weeks, is because when options become so dominant, it creates this almost state of illiquidity, just like as you mentioned, passive ETFs, because a large portion of shares in the market are already spoken for. They're not going to be bought or traded as people would trade them.
Yeah, and that's maybe explorations become more important than they've even were historically. But it's because I'm sorry if I didn't completely get it, but you created this model and it's open source. I think you put it on like one of those places your software people do. It's GitHub. Yeah. And so what are you're watching the difference in some kind of a delta exposure of net delta exposure, was it?
So sorry, I'm just adjusting the camera.
Oh, sure.
The sun is moving. What we look at really is this relationship between share volume traded in the day and the net delta of all options that were traded on S&P, for instance.
Okay, so you're watching that illiquid, like if it gets illiquid, that plays into your forecasting of your model.
Yeah, so I'll just walk you through, one of the most common and beloved versions of how to use the model for trading. So we talk a lot about this concept of reversions, where, at least classically, SPY goes up, SPY goes down, that's a price reversion. And what we've noticed, and, we've actually done back tests on 2020 data, so I haven't looked past that so far, but I've been also forward testing, is that when we measure the state of high option dominance, which is really represented by the magnitude of my metric, the note, then SPY has a tendency to reverse direction. And, my hypothesis for this that I worked on with a couple of people, like, my teammates like Casey and Isaac and others, was that so SPY is an interesting case, first of all, because we found evidence that most of the options traded intraday on option expiration are 0 days to live. So they're very short term, and a large portion of its open interest turns over per day. And what that means is that what's traded intraday, some percentage of it is written, which means that this is a new contract and that the market maker on the other side of it needs the hedge. They can hedge through futures, they can hedge through other options, but some percentage of those will also be hedged by buying and selling shares on SPY. And what happens is that when this metric gets to a high magnitude intraday, either negative or positive, our hypothesis is that basically the market depth at that point has been exceeded. So what's happening is that there's a certain amount of shares on the order book, which is, the open buys and open sells of all market participants. And the requirement of hedging here of these new contracts is actually putting pressure on the available liquidity at a certain point of the day. And what happens is you have this it's not a liquidity hole in the classical sense, but it's a mini zone of low liquidity. And we've actually seen this because of the model's really close relationship to breadth and the order book and order flow in general. We've seen that, when it gets to a high enough point, there's a strong tendency of SPY to reverse direction. And this is what we call reversions. And this is why, that's so popular, because it gives you this way to predict going forward 10 minutes, 20 minutes, 30 minutes, an hour, which really flies in the face of a lot of stuff like the efficient market hypothesis.
Sure, but also I think I never got into it because I don't know why, but the short-term trading, it should be the most predictive if you can find something, and it's just often very hard to overcome in terms of trading costs and stuff like that. But it's also one of the most promising of finding something in price actions. I think, it makes sense. So that, super interesting. And you're still developing that, and now with numerous people. And maybe so are you using it in your trades because you also have like an interest in like memetics? Are those separate things?
They are.
Okay.
They are. I mean, I do use the NOPE intraday, and I know a lot of people do. Like, we actually have a Discord where there's a dedicated channel for people who are using it as an indicator intraday. If you've checked out like my Twitter, there's a large amount of people who do use the signals that I've generated from it, basically, to pretty good degrees of success, I would add. And this memetic stuff that you talk about really was an idea that I got pretty recently. So, I mean, NOPE is something that I've been working on since August last year, I would say, or, late July. We got really lucky that, when we started observing it on the S&P, that was when the September 3rd correction hit. So immediately it was like, okay, we saw the signal, something bad happened, there might be a relationship here. And, that was like basically the apple that fell on Newton's head.
Because especially good at like these reversions, and those include like the drawdowns.
So reversions are just an intraday thing. So
okay.
You're never going to see like reversions, because basically comes from the mean reversion effect. You're playing this aspect that this magnitude of the NOPE should be going up and down, but the long-term, mean and median of it is basically zero. Mm-hmm. So you're betting on it returning to zero. But what's more interesting, and I think very salient right now, is its relationship with, correction periods. And the reason is pretty similar. Was, at least my hypothesis is twofold. It's really associated with these correction periods on the positive side. So if there's a massive cold delta skew, so not only does that imply to me that, there's this irrational exuberance that people, when they were buying a lot of calls on SPY, for instance, it's really a signal that, there's a lot of mania, there's a lot of bullishness. Those are the best times for the correction to happen. And you can see historically that, that's why put-call ratio is a pretty good contrarian indicator. The other aspect, this is more on the market microstructure, is, when we measure this by the end of the day, classically, these market makers want to go flat. Nobody really wants the overnight risk of holding, basically deltas on their book, unless they're specializing in that. And, that's really why we assume that toward the end of the day, this metric should go to zero long term, and it does. It goes over months to, that's what the mean and the median is. But when we see this large deviation, especially on the positive side in magnitude from zero, what this means is that there probably was not enough liquidity here. Like there was some dynamic that basically said, okay, could not go flat. And that's a warning signal. I mean, when the liquidity starts, basically disappearing from the market, then, you get this heavy sensitivity to perturbation. And when things are sensitive, it's really like you're stacking timbers in a forest. Like sometimes you'll be fine. Sometimes you have a forest fire.
Sure. So that's cool. That's interesting. And then maybe can we, because maybe GameStop ties like a few of the concepts you're interested in together, I think, and it's on everybody's mind. So I think you wrote about it, so maybe that's a great one to talk through, and then you can like explain how you use your stuff in practice. So how did you view GameStop, or how did you experience that whole
What's
thing?
interesting is I have like an interesting perspective on this because, I came from the day trading community. So there was a large overlap of people from like Wall Street Bets. I do know some of the OG people on there, not in like a, personal, I met them in real life way, but in the we're online friends kind of way.
Mm-hmm.
And, I've known about this GameStop story since August of 2020 when it was still around $6 or $7 a share. And it's been interesting to see its growth. I talked about this in my blog post. There was always this strong appeal because GameStop was by itself a meme before it was this meme. People would joke, oh, they're going to give you like $3 for store credit for your whole like console. I mean, I think everybody was kind of tickled when it started rallying because it doesn't make any sense from a fundamental perspective, past the free cash flow issue. I mean, you can cut it any way you want, but there's a pandemic. GameStop revenue declined in its last, earnings. I know I'm going to get a lot of flack for this, and I can understand why people had a fundamental view on it, but it's just hilarious. Like, there's no reason other than the sense of humor that it should have been the one to just pop right now. And it really relates to the concept of memes. I talked about it in my blog post on trading salience. Effectively, there's a large and long-standing relationship with this idea of funny and this idea of, narrative-driven, what I call storybook stock. Elon, for whatever reason, he knows his audience. I mean, even, Chamath is getting on this on Twitter too. He makes a lot of meme references. He really looks for this funny. And I think there's a deeper connection because, Tesla stock rallied. It's not only because everybody suddenly believes Tesla is going to make the future of mankind. That is an aspect of it. But Elon's public persona here was also a significant driver, in my view, of why there was so much mania around GameStop. On Tesla. People remember him. People like to emulate him. People think he's hilarious. That keeps this concept of Tesla in their mind, even when they're not thinking of the market. And I think that's a big aspect of why stocks like GameStop rally, because they keep this salience. They are on top of your mind, even when you're not thinking of it. If you thought of a game retailer, it would be GameStop. If you think of a movie theater, it would be AMC. If you think of some shitty dead company that used to run videos, it's still Blockbuster.
Right. And yeah. So do you, because I also thought like this whole short squeeze thesis of them with like they have like an enemy who's like the hedge fund, and at the start it was what was this guy? What was the hedge fund? Melvin. Yeah, he was a little bit of an unfortunate victim. But then Citron came in, and that was great because he's like he's like the shorts, you know, he's a symbol for the shorts,
Mm.
you know, a well-known short seller, and huge amount of respect for him. But that was like throwing fuel on the fire.
Yeah, and I mean, at least retrospectively, you could almost see this as like, what was he thinking? Because the internet loves to be challenged. There's literally an effect of this called the Streisand effect, that when you piss people off or when you tell them not to do something, let's say his points were completely valid and GameStop is a $20 stock. I will never say that because I don't want to risk my safety, given what I've been seeing. But let's say it is, but you basically made an open taunt to them and said, I know better than you. I am going to tell you what this is worth. And I mentioned this, I think, on my recent show on Real Vision, that there was a call sweep, or a put sweep rather, about $1 million on GameStop right before he, mentioned this on Twitter. And I'm not going to go into the legality of it because I'm not a lawyer, but this pisses people off. And there's no way to better rile people to actually, continue the story and to do the exact opposite by doing what Citron did.
Right. And then, but I was thinking, like, because this, I've been on the wrong side of Wall Street bets a few times, and I've really felt like I've been a neo short when it's like $1,
I
and
actually shorted you once and I got really lucky.
because now it's like $57 or something. But I think I had to like cover, like, yeah, I maybe at 2 I covered, and at 3 and a 4 and a 5, maybe 6. Ooh, and I put like put spreads or call spreads on, spreads on, so I wouldn't get killed at some point. But that was like it's not a great company; it's a really bad company. But it's got this. I think it was Wall Street Bets who were really loving the stock, liking the stock, I should say, and it was unbelievable. But it also kind of saved the company because that's how they got to raise a lot of capital,
Hmm.
and that's what they really needed. So that helped them out. It probably increased value, but not to $57, I think. But but anyway, that really woke me up to. That didn't wake me up actually, but now with GameStop, when I saw it again, um, it was very like this squeeze on that fund made a lot of sense to me because I felt it. Like I had to buy back, even though I was like, this is ridiculous, you know.
I mean, yeah, being the counterparty on this trade right now, I would not recommend people. I would not recommend people short GameStop. I've had
Oh
people.
no, no.
I mean, I did actually short GameStop. And people have mentioned on Twitter in December. I shorted it when I was 21 and I covered at 17 or 18, 17, I believe. So I made money. I was happy about it. But at this point, not only are there better trades, because everybody knows eventually it's not going to be $300 a share. It's really a game of chicken, basically, or market manipulation. But at the same point, why take the risk here?
Yeah, but I thought that was really interesting that they can force some shorts too, and that's a difference with like a true pump and dump where you just convince others like, oh, this is a great stock, and they believe it and they buy your trading sardine. And in this case, they really found like a tactical point of a vulnerability of these funds, and then also I saw these other stocks that they were going after, and you you connect these stocks, right? But they were also, many of them were like Melvin shorts, um, or some of the other funds that were affected. I think I saw a lot of. I thought they were really going after these funds.
I mean, like I said, in my blog post, this is the year the retail investors realized they could whack-a-mole hedge funds on their shorts for money. I mean, I would argue in a lot of cases, first of all, what are you thinking with shorting these stocks without some kind of risk management, in place? I mean, out of the money call options, a lot of them do it with puts, in their 13Fs, but at least word on the street is, because I did actually an analysis of Melvin's last 13F. And, if they had just done the puts that were mentioned here, they would not be nearly in the same position. Are they shorting shares? Did they short them naked? I think we're going to learn when the documentary on this comes out. um, but a lot of these funds, went into these very highly crowded short trades. And, I was talking about this on Twitter with some others like Alex Good. And for years, Wall Street saw these highly shorted trades as its own piggy bank because there was this self-perpetuating cycle here. People would short, these companies, the stock would go down, more people would short, these hedge funds. I think Chris, he runs a blog called, the Watchtower Meta, and he talks about this as well, that basically when you're running a long short strategy, as the stock goes down in value, your position also goes down, or rather your exposure on that short. So to match the same returns, you actually need to increase your short. But when you do that, you're also increasing your risk. And, I don't know if this will lead to liquidation of funds. There's definitely rumors that some of these moves on the long side have been degrossing and deleveraging of funds that are at risk from the short squeeze. But hopefully some people learn the lesson at least.
Yeah, it's not a completely new lesson, but yeah, you have to notice with these crowded shorts. But I think it's new that people go after it with such vengeance. It's also something maybe it will be interesting to you is that like there's like these activist shorts, and I like that strategy. I think it's a cool strategy, especially if they really find like companies where something's wrong. And like recently there was one, and I think it's called Penumbra, and it did some kind of a medical device.
Yeah, I know.
And yeah, because there were like some activist reports, real detailed that something was wrong with that the medical device they were yeah. And they published that, and I think the same day, initial goes down a little bit, that stock, and then it jumps back up. And now I was thinking, like, maybe people are really realizing that, like, Citron, who probably put on that put position with GameStop, those short guys, they are putting on a huge put position before publishing a 200-page report, of course. And often they leverage like the balance sheet of somebody who's got a lot more assets under management. They got some kind of a deal, and so there's a lot of money like short. And so I think maybe some traders figured that out. Like they're super short, maybe short term, and if you push it back, I don't know, maybe that puts them really in a box.
Yeah, I mean, I think this saga, ignoring the potential other ramifications of options trading, in the hedge fund industry, really did damage the credibility of the short seller, the activist short seller, because, while their intents may be good, like you said with Penumbra, where people I think actually were dying or injured by their device, now people see it as, oh, okay, this person's short, this is free money, I'm just gonna go along. And you saw that. I mean, it worked, right? Because you saw that. I mean, I talk to people in the day trading community pretty often, still, and basically people see, around November, if I recall correctly, Citron wrote a small hit on Neo, wrote one on Laser, or Luminar, I think is their actual Laser, I think is the ticker. And they bounced back. I mean, it took maybe 5 days, 10 days, 20 days. So instead of seeing this as a warning volley, basically that, okay, these companies are actually, bad, like something that like Muddy Block does, for instance. Like the Luckin Coffee scandal. Around late last year, what happened with Citron was he was just tweeting, this stock is worth $20. And instead of giving comprehensive reasoning why or targeting stocks that were, let's say, completely fraudulent, he was effectively, telling the market, I know better than you. I tell you what the stock is worth, and I'm going to vaporize all your call options. So it's pretty natural at this point now that people are going to see it not as, oh, the short seller, is short the stock. I really need to exit my position. They'll be like, okay, free money here. I'm going to wait till it falls and then buy in again.
Yeah. Yeah, I think maybe try to bank on his reputation and maybe saw a little bit of weakness and thought if maybe it breaks the whole thing, but it obviously didn't in hindsight, and I think he's out now, and he doesn't want to publish anymore for a while, and because maybe so. How do you see this whole thing play out, like going forward?
I mean, I guess, are you more interested on the GameStop story or
Yeah.
the short squeeze basis?
No, I'm sorry. We were initially talking about GameStop, and yeah, I won't drag you into the entire short market.
I mean, so GameStop is undergoing at least potentially a short squeeze. I mean, we've seen the short interest update. I'd argue a lot of it is just market makers who are short the stock because they have to be, because people are buying put options on it. It's also probably more importantly undergoing both massive amount of momentum from likely algorithms from other hedge funds, as well as retail buying call options out of the money to trigger a GAM squeeze.
Yeah,
So it's an interesting confluence of like factors that are building this real Tower of Babel, and everybody knows eventually it's going to break. I mean, nobody is a thing at this price point deluding themselves that yeah, GameStop is $1,000 stock fundamentally. I mean, maybe with their Ryan Cohen fantasy that it'll be $1,000 in like 2040. Even then, I'd be very skeptical. Um, I can't really tell you when this will end. I mean, I think at this point it's morphed into more of this, movement of rebellion among the retail class against, the institutions. So it might have more legs than we thought or hoped, to continue for a while. I do think, eventually, I talked about this in my last blog post, there's a maximum amount that people are going to, want to buy it at. If GameStop hits $800, you're probably hitting the maximum that any sane investor is like, yeah, that's a position I'm going to enter. So assuming that this, mimetics effect continues, it's probably going to, eventually cause GameStop to collapse. But more importantly, once GameStop hits a certain point, you're going to see other meme stocks rally, because people who missed out on GameStop or people who made money on GameStop are going to try to replicate it. And we've seen that with AMC, we've seen that with Blackberry, Nokia, etc. And this may go on for a while.
and those are connected. How do you see those connected? Or
I mean, the two semantic associations that I talk about in my blog post, for instance, are vintage companies, so companies that people remember from childhood, because let's face it, most of these investors on Wall Street bets are probably around my age, around 25 to like 30. So Nokia, Blackberry really belong to that generation, and the other ones are really like these depressed retailers, as well as those who have like undergone the short squeeze narrative. So you're seeing stuff like iRobot rally just because it showed up on the high short squeeze list. You're seeing stuff like Build-A-Bear Workshop rally just because it's a retailer and it has some level of similarity, at least episodically, to stuff like Express or like GameStop, because they're all in the mall. So you can really like draw these connections. I think a major point that I talk about is these connections are only stuff that can exist in the human mind. You
Yeah. Yeah,
know,
you also
these,
mentioned like Funko. I thought that was a really cool one.
yeah, that was actually like my test of that this hypothesis. Basically, these connections, like I said, are really, human level patterns. And you're seeing this money move because people are thinking of GameStop. What do they think of next? They think of malls. They think of vintage companies. They think of nearly bankrupt companies. They think of products that are sold at GameStop. And what is sold at GameStop? Funko.
Yeah. Yeah, and that's also a little bit Left for Dead company that's actually got a pretty interesting product going. I think, but
It does.
who knows?
It does. My brother is actually he's autistic and he loves Funko. Like I think he spent hundreds of dollars there. And it's always been salient to me actually. I was in Funko, I was long Funko from about $6 to $10 because I saw that it dropped last year. I mean, pretty much reflexively after its earnings report. And it looked like a good place to park some money in.
Yeah, yeah. A lot of people are worried that it's a little bit faddish, but it's always a risk with the toys. But I don't think so. I think it will be around, but who
Mhm.
knows? Something. Yeah. So you're not sure how it will play out exactly with GameStop. You think some others will keep rallying, like in uh, like stocks that are connected in a salient way. How you put it right in your blog? Yeah.
Yeah, I mean, assuming this um, whatever you want to call it, this narrative, this social movement, we have some pretty good evidence that most of the people buying on GameStop are not, the downtrodden. It's more the tech pros and SF who are, putting disposable money on it. Not to say they're the only ones, but, some people on Twitter have done that analysis for us. Um, I think that assuming this movement has legs, and assuming that there is no real government intervention, I think people found effectively an infinite money hunt. There is really no downside as long as, these momentum algorithms keep chasing momentum and people keep looking for the next GameStop.
Yeah, that's interesting. I should ask you more about that because that's part of what Wall Street Bet does is it triggers like these momentum algorithms, or it can trigger them, and it's
Mhm.
actually curious to me whether people will override their strategies, like the quantitative people, because it's very annoying if people start, you know, pushing stocks to trigger your algo, and you're actually getting pumped and dumped. And to agree, they can even do this with indexes, but I think that's the next step. Like get
I
something in
mean,
a
yeah.
Russell in
Hopefully
May.
they don't figure out they can do this with like something like UVixy, you know.
Sorry,
And
what?
then hopefully they don't figure out they can do something like this with like UVixy or UVXY, because that might be a problem.
Hmm. Hmm.
Um, More importantly, I mean, I think the momentum chasing firms are making a lot of money here. I mean, I posted yesterday that, hedge funds are making, we have evidence that hedge funds are making a lot of money at others' expense. So I don't think that anybody's, really trying to avoid these scenarios. I think probably there are a lot of actors who will find out in the near future who are either taking advantage of it or potentially are partly causing it.
Sure, yeah, I think there's definitely professionals that are either riding it or also I think a lot of these other stocks, they're in the portfolios of Melvin and other short funds, and that's why it's cheap leverage to put more pressure on their portfolio, maybe forcing them to buy back the GameStop. But yeah, but when it turns, that's when the momentum kind of gets screwed because it's pretty hard to get out fast if you're quant. It's my understanding, but
I mean, I think that a lot of these funds specialize, and I don't want to, go too much in the speculative end, since it's not really something I've done, plus, can't really tell until everybody can tell.
Sure.
But I think a lot of these funds do specialize in these conditions. I mean, there was a recent graphic from Citadel, showing that net last week retail was, a net seller of GameStop. So
Mm-hmm.
someone was buying, whether it's these high frequency firms that moves in and out of the positions pretty quickly, or whether it was other hedge funds, or maybe it was, some more nefarious player. I mean, there's people who probably know what they're doing here and are making a lot of money right now.
Sure. Yeah, that could be. Could be. I also retail got a little bit limited with all the broker limits. Um, I thought it was kind of a little bit unfair. What did you think about that? Or
I mean, I think it was completely unfair. I have been kind of tracking the story. It seems that it didn't really come from the brokers themselves, although I believe Robinhood is actually its own clearer as well. So in that case, it is completely on Robinhood. Um, but it just reeks of price manipulation because, as I talked about in my post, the one that blew up basically about the gamma squeeze, um, a lot of people were waiting for Friday because of these 0-day options. And not only that, but people bought these call options with the understanding that the value would go up really quickly,
oh, so
which
you mean
I,
like the retail crowd was like keeping dry powder to push it all into like 0-day options on Friday? Huh.
I mean, that's probably, I mean, a lot of people have been, buying these options pretty much continuously and it was kept going up. Like, why would you stop? But I think the bigger issue is that, these brokerages were very happy to take the money when it looked like they were going to win. Then, as people have aptly put online, when they were going to lose, they just decided to take the bull and go home. I don't think it's particularly right to sell people these contracts that cannot be bought again because no shit, like once, they banned it, of course, GameStop the next day dropped like 25%. Of course, these options were worth a lot less. So you basically, whether on purpose or not, you basically took money from people. You literally, if you're Robinhood, you're not living up to your name very well.
No, it's such a complete disaster. If you ask me, it's so ironic. What I personally really came across very bad was that Citadel is supposedly like a customer of Robinhood buying the order flow, and they put in like 1 billion in Melvin Capital.
Mhm.
Or I don't know if it's 1 billion, but they and Steve Cohen were reported to put capital in there, and then Robinhood and others restrict trading, and it just looks so bad. That yeah.
I mean, throughout this whole thing, I've really tried to stay, focused on the facts here. I cannot tell you what Steve Cohen is doing on the vaccine or, Kenneth Griffin or any of these people. Optically, I agree with you. It looks really bad. A lot of people, I'm going to quote Alex Good again here. A lot of people, this bubble has popped that people thought there was a fair market. And, it seems like we've all known that hedge funds play these games. We all saw what happened in 2008 when basically the banks melted down because of what they were doing with, collateralized derivatives. And basically, this time when supposedly the retail investor was in charge and the retail investor was winning, and I know people who made millions of dollars off this GameStop thing. They said, nope, sorry, it's cool when we screw you. It's not cool when you screw us. So I can definitely sympathize a lot with people's anger here. I am not playing GameStop myself because I'm a pretty risk averse person by nature. But I would be pissed. I would righteously be pissed here, and I was pissed for people when I broke the news that Robinhood did this.
Yeah, yeah. I agree that I hope it gets looked into, and we'll probably hear more about it. There are some legitimate reasons why things happen, but it would be good if it's sorted out. Um, can I ask you one last thing, or do you need to go because we already kept you way longer than I was supposed to?
No worries. No, it's a Saturday. We're good.
Okay, that's super cool. I saw you tweet out that you were looking at possible silver squeeze. I've been, I've been really interested in silver because from its lows, it was quite low, like 6 months back, maybe 3 months, some months back, and put on some position. So, I'm interested in how you think about that, because I think there's like a good fundamental backdrop. Like some of these Wall Street bets ideas, because I think this is also a Wall Street bets thing, or that they are talking about.
Yeah,
maybe
well,
I'm
at least
wrong.
I mean,
But some of these have like real good fundamental backgrounds. Maybe they get a little bit out of hand, but there's.
I mean, yeah, I know. I think most of these meme stocks have some kernel of truth to them. I think the biggest battle, when we talk about this from main perspective for silver, for instance, would be it's just not that salient. People know silver and gold, but nobody has this, basal connection to it where you're like, yeah, this reminds me of childhood, or, yeah, this is something that is funny. Like nobody's gonna laugh when you say, oh, I'm gonna invest in silver versus, oh, I'm gonna buy GameStop. We're gonna pump GameStop. So I can't really speak too much yet about the silver squeeze. I haven't looked into it, and I'm gonna try to over the next week. I have known in the past when the metals were going up, for instance, in July and August, that, at least word on the street is that, the big banks kind of manipulate the price of silver. I, again, don't want to talk about this more in depth until I have more compelling research on this, but I'll keep you updated.
Cool. Yeah, there are definitely some historical scandals around the smaller markets. They can be a little bit manipulated, but I don't know either. Maybe it would have a better chance like a bear market, because those precious metals, sometimes they become more popular in these markets. Yeah, it's
or a lot of inflation.
Yeah, that would be great. Now, I really want to thank you for being on and talking about these things. Can you please tell people where they can find you and your blog and maybe your note tool?
Sure. So, I think the best place to start is just to look at my Twitter, which is nope, NOP underscore, it's ITS underscore Lily, LILY. My blog is the same. It's basically nope with dashes instead. So nope it's lily.medium.com. Might move it soon. The current nope tracker tool is linked on my Twitter. It's kind of a dumb, basically, like URL, which we're going to change soon. So just come look at my Twitter if you want to see it.
Okay, cool. Thank you very much, and thank you to the listeners for checking in. Please like, subscribe, share. It's much appreciated, and see you next time.